Hello, everybody. My name's True Demon, and I'm the Devil Stockbroker, bringing you a quick market update just to figure out where the market ended on the week. So far, semiconductors and electronic technology seem to lead the entire market, along with health services, finance, and the consumer non-durable sectors. So it's kind of a mixed market, but overall broadly green in the last week. Today's performance, on the other hand, was a little bit red. We saw some pullback in the market. Really, it was mostly just a chop day, kind of to be expected with Friday being only a half day of trading. There wasn't really much opportunity or enough volume for the market to move anywhere. So we'll catch up on how the market is performing on the week, starting with our SPY. So SPY, the market ETF, is currently setting up a couple of technical patterns that I wanted people to be aware of, starting out with the current moving averages. So right now, we're seeing some bullish momentum in several moving averages. These are the EMAs that you're seeing here, with white, blue, green, orange, red being the 10, 20, 50, 100, and 200 daily EMA candlesticks. So looking at the SPY right now, we see that we are clearly in bullish territory. However, we are printing several bearish indicators, starting with this ascending wedge on the overall market. This is a classic reversal pattern showing that the market is getting ready to hit a top. Now, we've been in a bit of a market rally mode for the last week. We were really hesitating around FOMC. The market was undecided up until the notes were released, and we saw that the Fed is planning, or at least agreeing, that a 50 basis point hike is pretty likely. So now the market is pricing in a 75% likelihood of a 50 basis point hike from the Fed, which would be a little bit slower than their usual pace. And the market is reading this as bullish. That decision is not going to come until mid-December. And at least for the next month, the market does have a little bit of room to run. So after removing some significant support levels from my day trading indicators, we can see that the SPY is now trading above its 200 period EMA. When I switch this to simple moving averages, we see a little bit different story. So the SPY is getting very close to tagging its 200 daily EMA. Once it gets to this point, this is where bulls should be very nervous about going long. Once we touch this period, this 200 period simple moving average, it's clearly a very close to the top. In the first run of our market back in March, we did clear above this, but it was before the market had become decidedly bearish. The question of whether we were actually in a bear market was not quite decided at the time because of this rally, but since we declined a little bit further from there and ended up putting in a new lower low in April and May, it was decided that the market had become a bear market. The next time that we touched this moving average was right here at the peak in the 16th of August, and the market promptly turned around after the Apple rally had ceased and all of the big tech sector stocks, the big growth sector stocks, all started to move into decline. Moving over to the SPY over HYG ratio chart, we're seeing that currently the bond market is also forming an ascending wedge. And for right now, the market seems to be in agreement, but I want everybody to be aware that the MACD has crossed over. It does look like it may have the potential to bounce, but it would be very close to call. If we don't get a bounce where the market surges one last time, then this could start to turn around and we may see the bond market begin to disagree with the momentum of the overall SPY. For the first time, we've seen some divergence in the HYG versus SPY, where we see HYG forming a higher high while SPY is forming a basically a double top pattern. So this would indicate to me that at least for the time being, the SPY is going to remain bullish. We may see some more momentum going into next week, so be on the lookout for that. My expectation for the SPY is that we can reach a high of 410, which puts us right at the peak of this bearish megaphone pattern, which you can see the highs start here on this white line that I'll now turn to yellow just so that it sticks out a little bit better. So once we break up to the peak of this bearish megaphone pattern, I will be considering that close enough to be the top. I'm not going to challenge the market because we're clearly not ready to rally back to the upside and switch back to bull market mode. Fed is still in tightening mode, and they expect to be doing so for the next year at least, and probably going into 2024. especially with their balance sheet runoff. The balance sheet that I'm speaking of is the Fed's current holdings of $8.677 trillion worth of treasuries and mortgage-backed securities. This balance sheet is the largest that the central bank has ever held to date. And there is some decline, but it's expected that a lot of this decline has to do with the actual losses of the assets underlying rather than the Fed reducing its balance sheet overall. If it is in fact the case that the Fed is now losing value in its balance sheet just because of the losses of the value of the assets, then that's actually very bad for the market, because what everybody has been expecting is that the market has been declining partially because the Fed has been selling assets no matter what the market price gets to. If we find out, in fact, that the Fed has barely only touched its debt, which seems to be the case, as of September, the Fed has only shrunk its balance sheet by about $133 billion worth of bonds. As of November the 10th, the Fed has promised to allow up to $95 billion of bonds to roll off of the balance sheet per month over the course of 2023. And as of the latest report per thinking.com, the balance sheet has only shrunk by about $0.5 trillion. I would tend to disagree with this figure because the reports of what the Fed is planning to roll off vastly differs from what actually has been reduced on the balance sheet. What they are reporting as intended to roll off was $500 billion. To date, their balance sheet has only shrunk since its peak by about $291 billion. So the math doesn't work out. The reason why this should matter to you is that when the Fed does eventually start putting its selling pace into full gear, then this balance sheet is going to start shrinking very rapidly on this pace down towards $8 trillion. And when that starts happening, that's going to put some immense pressure on the SPY, and actually we'll see a very rapid decline in the market. I have little doubt that we're going to see a big decline starting at least in the spring, and we will see a new low by March. But to date, we're just seeing the Fed allowing the market to continue to pump for bulls to have their day in the sun. What should you expect to show up in the charts in order to predict when the market sell-off is going to begin? I would start by keeping a very close eye on this chart. We have a MACD here with a price cloud oscillator by Peaceful Lizard. Absolutely love this indicator. We've now had a bearish crossover on this, and we are currently waiting for the RSI to put in a lower high while the price puts in a higher high. So far, RSI and the price chart are creating higher highs together. So this does not meet our qualifications for bearish divergence according to my strategy, and we do seem to be crossing over with volume pushing past its fast moving average on the volume direction candles. When we put all of these signs together, it does appear that the market has at least one leg left in it to push to the upside, and we may see us clear $409 on the SPY. If we do reach that level, I'll be looking for that bearish divergence to appear at that time, because by then the RSI will have ballooned up to this new height. And on the second high afterwards, we're very likely to see a lower high in the RSI, putting in a downward slope, our first down slope. If we do end up getting those indicators to our favor, then we'll be entering into a 60-day swing to the downside. But for right now, we're just going to day trade the market, play the moves in short term, and keep ourselves liquid with cash. So we'll be playing the market in both directions and playing the trend on 5 and 15-minute charts. For those of you who are less day traders and more swing traders like me, that kind of means that you'll probably be sitting this out while we wait to chop to the top. Hopefully you're already in some long positions that you still have been riding since we called the bottom here and have been able to ride this to the upside. It looks like we still haven't hit the top quite yet, but it's been getting really, really close. The Qs have put in their first lower high on the price chart with the RSI agreeing slightly. That does indicate that there's been some healthy pullback, so I am expecting for the Qs to hit this limit order before making another run. I am not sure that it's going to reach its 200 period moving average, more likely that it's going to come up a little bit short of that. I'm expecting more for it to respect the EMAs. So if the Qs is able to come back to this level, we can take a long position for a swing to the upside to touch its 200 EMA, which is a little bit lower, just below $295 on the Qs by the time we get there. The real play I think that will be coming here is going to be the energy sector, which I expect to be the underperformer for the next couple of weeks. We've already had a head and shoulders appear in the market, and we're now waiting for the XLE index to break to the downside. I've already called out a couple of stocks for folks to watch out for. XOM for ExxonMobil, which also has printed a triple top, along with Chevron Corporation, which has also printed a head and shoulders very similarly to what XLE has done. Once this breaks the downside and we see the bears start to take control of the momentum, I think that we'll likely see Chevron return to a previous level of support all the way down here at 165. In Exxon's case, this looks more like 104 from its current height of 113. The consumer staples index has been ripping lately, so a lot of the defensive sector stocks, especially foodstuffs and basic necessities, are really overextended at this point, but we are still in bullish territory. So this may still have some more legs in it, and we may end up ripping all the way up to 78.50 at some point. The resistance that I have here from previous points in the market indicate that about $78 is about the height that we can expect XLP to get to. A sector that I believe can continue running is the consumer discretionary sector, which is a very risk-on sector that's mostly associated with clothing and retail brands. If we do end up seeing this one push, then this could help lead the market and push it to the upside, while other defensive sectors begin to go into decline or at least stagnate. For this one, we have an inverse head and shoulders, bullish divergence on the RSI, and a pullback in the MACD with the potential to cross up and allow it to begin to run. So these are sectors to watch out for pushes to the upside. For now, the real estate sector is still showing some strength. We have not yet completed a new high here, but it looks as though this has created a cup and handle, and now we're waiting for the XLRE index to break the upside at around $39. Once it does break this level, I expect it to reach the top of its channel here around the 200 period EMA before going back into decline and starting to work its way back down to the bottom of the market. This is likely going to take some time going through the December season, and then once we start to see what the housing market looks like in the spring, I expect a flood of new homes to come onto the market and for the real estate market to go into decline. An opportunity here would present itself by going in the short term long on XLRE, and then starting at the end of December throughout spring and midsummer, going short and riding it to the downside. You can also play this with its inverse leveraged ETF, DRV, if you choose. So this inverse ETF is a personal favorite of mine that most people are probably familiar with by now, but essentially it runs 3 times the opposite of whatever XLRE does. So the idea is that if you see XLRE going up, you want to bet on this going down. And if you see XLRE going down, then you want to bet on DRV going up. So literally the opposite. And with a 3 times leverage, you can get some really good consistent gains out of relatively small moves in the real estate market. So for right now, I am anticipating that the market is going to continue to set itself up for a strong close on the year, and then we will probably see some bearishness take over in the real estate market later on after January. So I'll be marking the date, and we'll keep a close eye on this one. Another sector to keep a close eye on is stocks over the Qs. When you see that we've been trading in this megaphone pattern in the stocks over Qs ratio chart, you can see that right now the stocks, which is semiconductors, the Philadelphia Semiconductors ETF to be specific, is very close to its top. It actually created a double top formation, and if I were to drop the SOX onto the chart, then you can see that right now this has created a higher high and a lower high on its price chart. You could interpret this as being a bull flag, which it does appear like it is bull flagging just a little bit. However, we got this rejection candle after this inverse hammer candle completed on Wednesday. So now we've gotten yet another bearish candle with a tall wick here on the daily. So it does appear as though the semiconductor sector is starting to top a little bit, but we have to watch carefully because this is one of those aggressive growth sectors that can run with the tech sector along with the rest of the market. So this is probably going to be one of the market leaders. If we start seeing stocks continue to weaken and we do not get this bullish cross on the MACD, if this doesn't happen and we instead reject and move to the downside and complete this double top formation by breaking down below around 2,650 on the price for SOX, then that may indicate that the rest of the market is ready to move to the downside. Until I get clear bearish indicators and signals triggering across the market, I'm not ready to go short on any of these sectors. I'm just playing the short-term swings every single day or day trading with as much of my portfolio in cash as possible. Now for the really scary stuff. Here we have the 10 over 2-year Treasury yield curve, which shows us the spread between the 2 and the 10-year U.S. Treasury market. The idea of this chart, if you're unfamiliar, is when the Treasury curve inverts, or when you see this line go below the 0 line, that means that 2-year Treasuries have created higher yields than the 10-year Treasuries. This has been a 100% accurate predictor of recessions in the market. And right now, I would argue that we are already in a recession, but now we are approaching the deepest inversion in the Treasury curve since the 80s. We've actually surpassed the low in the Treasury curve in 1982, which led us into one of the worst recessions following a massive stock market crash led by inflation. The lowest historically that we have ever had in the market took place in February of 1980, which would see us with a almost a 2% difference in the 2 and 10-year Treasury curve. What tends to happen when this Treasury curve starts to uninvert, meaning that it begins to move above the 0 line, this is the period of time that marks the beginning of the capitulation of the stock market. This happened in both 2008 and 2001, leading into the dot-com bust, where as soon as the Treasury curve uninverted in 2001, it immediately triggered sell-offs across the market. In 2008, the Treasury curve uninverted in April of 2007. We had the subprime crash that occurred 2 months later, and then next year in the fall of 2008, the market completely capitulated and fell by more than 50% in just a month. The deeper this curve uninverts, the worse the recession, and this has been consistently the case for every single one since this has been recorded. The last time that we were this low, we went through a period known as stagflation, where we had extremely high inflation of the dollar simultaneously with extremely low job growth. And this was a situation where the Fed had no ability in order to fight it without creating serious pain, and their only response to it was to raise the federal funds rate to a record high of more than 19% in order to drive inflation down forcefully. Right now, the Fed is moving so slowly, in my opinion, that we're not going to escape this situation, and we are going to eventually approach a period of stagflation if the market doesn't cool off, and if we don't see inflation start to come down. We had our first good CPI report in the entirety of this bear market. This is the first one that really actually exceeded the Fed's targets. And the Fed is going to need to see this consistently occurring for the rest of the next year in order for them to have any faith that what they are doing is working before they start to pull back on their quantitative tightening. Until they see consistent drops in the CPI, consistent increases in unemployment and the jobless claims, the Fed is not going to back down. So we're many months away from any kind of relaxation of the interest rate. We're definitely not going to expect any pauses. They are going to need to end up accelerating at some point in the next year. At the very least, they need to stay on a steady pace of 50 and 75 basis point hikes for the next 6 to 12 months before we can see any pause. Right now, so far, the dollar index is showing that it is moving down, which is actually a good thing for the stock market. And as long as the dollar index is continuously moving down, then we could expect to see further bullishness in the market. However, what I do want everybody to be very aware of is that for the first time in this bear market, the dollar index is about to approach its 50-period weekly EMA. So this is going to be new territory for us. If we see a bounce off of this level, then it could be an extremely aggressive rise in the dollar. And if this occurs, then we're sure to see more inflation and more drops in the stocks market. The only stock that I want to put in front of everybody for a major bullish swing to the upside is Tesla. Tesla had a massive amount of premium placed on it to the long side just in the last day. Friday was overwhelmingly bullish for Tesla. A major institution spent well over $1 billion on calls for Tesla going out to 2023 and 2024. Almost every single one of these was a multi-leg spread strategy that took the stock all the way out till June of 2024 and even out to January 2025. This institution, whoever they are, spent a combined total of $694 million. Much of the cost was offset by selling further out of the money calls, so altogether, each of these represent a multi-leg call spread. Essentially buying an at the money or in the money call and then selling a deep out of the money call in order to offset the cost. There were some smaller institutions that spent a few $1,000,000 purchasing puts and selling some further out of the money puts in order to kind of offset their cost. Essentially, what this institution ended up doing was selling an extremely deep in the money put up at $475 and then buying $400 puts at the expiration of January 2023. It's really hard to say what these institutions are thinking, but I'm guessing that they are looking to pull some premium out of a very, very strong pullback in Tesla. So it looks like the entire stock is winding up for a big bounce. I want everybody to be aware of it so that they can position themselves accordingly. I am long on Tesla, so just get that little disclaimer out of the way. This is not financial advice, but this options flow is extremely bullish to me. So I would be watching this very carefully and decide for yourselves what you want to do. But based on where Tesla currently is in its chart, having set up multiple lows with a descending wedge, breaking that wedge just recently, and setting up higher lows on its MACD along with its RSI, this indicates to me that Tesla might be ready to start pulling back and move back up towards the 200 level. I'm not sure how much further it can get beyond that, but at least to the 200 level for a quick 50% retracement over its last month of trading. Based on those figures, the 50% retracement level would place Tesla at around $209.50. I would expect such a trade to take at least 1 month to play out, so betting on after December 16th, possibly out to January, might be the ideal swing in this case. And for those of you who are playing with small capital that need to take small bets on these things, and Tesla is outside of your price range, you can consider betting on TSLL. This is a bullish 1.5 times leveraged ETF that you can use to play Tesla to the long side. By going long in this stock, you're betting with Tesla, betting on it going up. So if that were the case and Tesla would be able to retest this previous level of resistance, TSLL would get up to around $14, and then the next price level would be at around $15.30. Absolute maximum take profit on this one would be at $17.50. That's going to do it for this market update. I wish you guys the best of luck and have a hell of a time in the markets. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.